If you're always stuck looking at the charts, not knowing what price is going to do or which direction price is going to go in or what direction you should be trading in, what you need is you need to be able to identify your daily bias. Your daily bias is what's going to let you know if you should be looking for buys or if you should be looking for sells. And in this video, I'm going to be showing you how to easily identify your daily bias. So if you're not subscribed already, make sure to subscribe and let's get started. So how do you identify your daily bias? What's your daily bias? It is what tells you the direction that the market is going to be going for the day or for the week, right? So we're going to be diving into that. So I'm going to be showing you how to know what direction the market is going and if you should be looking for buys or sells. This is something that most of you have been struggling with. You don't know what direction the market is going. You don't know how to identify the trend. You don't know how to accurately identify the trend. Maybe you know how to enter the market, you have a pattern, maybe you're using my type 1, type 2, or type 3 pattern, but you don't know what direction the market is going to. Now, if you know how to enter the market, you know your entries, but you don't know what direction the market is going to go to, it's going to create a lot of losses when you're trading because you're going to be looking for buys when the market is actually going to the sell side, and you're going to be looking for sells when the market is actually going to the upside. So that's going to give you a lot of losses. You're going to lose trades because you're going against the market. You don't know what direction the market is going to overall. All right, so that's what I'm going to be clarifying for you in this video. There are three main ways that you can use to identify your daily bias, and I'm going to be explaining each and every one of them in this video, so make sure you stick to the end. Also, we have you have the first one, the second one, and the third one. The third one, for me personally, the third one is the most accurate. That's the one I'm using currently. That's the one I've been using for years. It's the most accurate for me. Like, I can literally come on the chart and in 10 seconds, 15 seconds, 20 seconds, I'm done. I know the direction that the market is going to go for that day. That's the most accurate, and I'm going to be revealing that one at the end of the video. So make sure you stick to the end of this video. Also, this is also what I teach my students. It's called market maker levels. So I teach my students, and if you want to learn more on that, you can enroll and be a student. Link in the description below. So, what is the first way to identify your daily bias? And that is using market structure. Using the typical market structure. Now, what is that? What's the typical market structure that we know? So for those of you that don't understand market structure, this is how you identify your trend using market structure. We know that market structure is basically the skeleton of the market. It's what shows you the structure of the market, and we have three main structures. You have an uptrend, a downtrend, and consolidating markets. We know what an uptrend looks like. An uptrend provides you with higher highs and higher lows, and that's what tells you that the market is going up. So the structure of an uptrend is you have a high, you have a low, you have a higher high, which breaks above this recent high here. So we have, let's say we have a low here, and then we have a high here, right? Then price is going to pull back or retrace, and then it's going to continue and break above this area. That's a that's a break of structure, right? Price is breaking above this high here. That's a continuation. So when the candle closes above this, that's a break of structure. Price has broken above this high, and that has given us a higher high. The reason why it's called a higher high is because this high is above this high. All right. So that's why it's called the higher high. So let me see if we can do this. So, not to interrupt, but if you're interested in ways of trading bigger capital, let me introduce you to the sponsors of this video, Blue Guardian. Blue Guardian is a prop firm. In case you don't know what prop firms are, they are firms that provide you with capital to trade. You trade, then you and the firm share the profit. Blue Guardian has been in the prop firm industry, and they have been around for 3+ years since 2021. With them, you can get funded with capital from $5,000 all the way up to $400,000. They have a 1-step, 2-step, and 3-step challenge accounts to choose from. They also have an instant account in case you're not a fan of trading those challenge accounts. And since I'm partnered with them, you can get an account with them for a discount. So make sure to use the code DAN32 to get a discount. As always, click the link in the description below to get an account with them. We'll have a high represented by H. We'll have a low represented by L. We have a higher high represented by HH, right? Higher high. Then after that, you're going to get a higher low here. And then we're going to get price breaking above this high again, which is going to give us another higher high. So this is going to be another higher high here. And price is going to give us another higher low, right? So this is going to be HL, higher low. This is going to be another HL, higher low. And then when price continues in this structure, that tells you that price is in an uptrend. All right, price continues in this structure, that's an uptrend. Now, if price does the opposite of that, then it's a downtrend. And this is what the opposite looks like. So you're gonna have a high, then you're gonna have a low, then you're gonna have a lower high, then you're gonna have a lower low, lower high, and lower low. So these are the highs here. This is the high, this is the lower high because it's lower than this high, and this is the lower high because it's lower than this previous highs, right? And then we have the lows. So this is the low here. Then we have a lower low because it's lower than this previous low, and then we have another lower low here because it's lower than the other previous lows, right? So we're going to represent that with abbreviations. We have a what's it called? We have a high, right? We have a high here, and then now we have a lower high, which is going to be LH. We have a lower high here, LH. For the lows, we have the low, and then we have a lower low, it's going to be LL. We have a lower low here, which is going to be another LL. So this is the structure of a downtrend and an uptrend. So this is an uptrend here, and this is a downtrend here, right? So these are two structures. Uptrend gives you higher highs and higher lows. Downtrend gives you lower highs and lower lows. Now, a consolidating market does this. It gives you equal highs and equal lows. So you're going to have highs and lows, and the highs and lows are going to be equal. So instead of having higher highs and higher lows, or lower highs and lower lows, you're going to have equal highs. So these highs are going to be equal to each other, and these lows are going to be equal to each other, right? So just call it equal lows, EL, EL, right, for the abbreviation. So you have equal lows here at the top side, you have equal lows at the bottom side, and that tells you that the market is going sideways, right? So the uptrend tells you that the market is going up. That's the structure that it gives you when the market is going up. And when the market is going down, it gives you this downward structure. And when the market is going sideways, it gives you this sideways market structure. So now, how do you identify your daily bias using this method or using this market structure? Basically, you come on the chart and you look and see what structure is the market giving you. Is it giving you an uptrend structure, or is it giving you a downtrend structure, or is it giving you a sideways market structure? If it's giving you an uptrend structure, then you know that for the day or for the week, you're going to be looking for buys. If it gives you a downtrend structure, then you know that for the day or for the week, you're going to be looking for sells. If it gives you a sideways market, a sideways structure, it means you can look for either buys or sells. Right? You can trade buys, or you can trade sells. All right. So uptrend you can take buys, downtrend you can take sells. Sideways market because it's not going up and it's not going down, it's just going up and down. So that means you can trade in both directions. You can take buys and you can take sells in that scenario. So what does this look like on the charts? So to make it easier, if you want to identify your daily bias, it's easier to look at it on the 1 hour chart. That's the best way to look at it so that you can see the bigger picture. So if you look at this here, we can see two structures. We can see we have, where's my arrow? We have an uptrend here, and we have a downtrend here, right? So how do we identify the uptrend and downtrend? So this is the lowest point for the where this uptrend started from, which is this point here, right? So let's look for our structure. So we have this low, and then what do we have? We have a high here. This is a high. Draw a line here. Once price breaks above that line, that's a break of structure to the upside, continuing the trend. So we have the low, we have the high. So we have the low here, L, then we have a high here, what is it called? H, right? So when price breaks above, we have a, what is it called? Higher low, HL, and we have a higher high here, right? This is going to be our H. Then we have a, sorry, HH, higher high. Then we have a higher low here, and we have what? A higher high up here, right? So price keeps on breaking above the higher highs, breaking above, breaking above, breaking above, right? That tells you that price is in an uptrend, right? So in a situation like this, where you see price broke above this high, you know that you're in an uptrend. So from that point, from this point here, you know you're going to be looking for buys, right? The market's giving you an upward cycle, an upward structure, an uptrend structure. So you're going to be looking for buys. In the case of the downtrend, what do we have? We have the high here, right? And we have the low. The price forms a lower high. And then what's important here, because this was an uptrend before, what's important here is that price broke the structure. It's also called the change of character, right? Price broke this upward structure. So instead of giving you higher highs, it now started giving you um lower highs and lower lows, right? So this low here is lower than this low, right? This low here is lower than this low. So that's a lower low represented by LL. We have lower high here, LH. We have just L here, and then we have high here, right? Then we have the low, then we have the high, the lower high. As you can see from this point here, from when price broke below this structure here and gave you a lower low, you now know that price is now in a downtrend, and you can see price continued going down. Price continued going down all the way here and kept on giving you lower highs, lower highs, lower lows, lower lows, lower lows, lower lows, lower high, lower lows, till price eventually broke above all this other structure in here. All right, and then you can see price now started giving us a different cycle, which is the consolidating market. So you can see the consolidating markets here, price from the high up here, from the low down here, and price is just at the middle. So in this scenario, you can take both buys and sells because they're just giving you the same thing, right? So you have the high here and you have the low. Price needs to break above this high for it to be an uptrend. Price needs to break below this low for it to be a downtrend. So in this scenario here, price is just going sideways. So in a market like this, you can take both buys and sells. So this is one way that you can identify your daily bias using market structure. Now, the second way you can identify your daily bias is by using what we call moving averages or EMAs. EMAs, exponential moving averages. That's what the full for EMA is, right? So this is one other way that you can identify your daily biases using moving averages. Now, this one is very, very simple to do. Very, very simple to do. It's easier than using a market structure, but it's less accurate than the market structure, but it's easier to see. Mainly because the reason why it's less accurate is because of indicators lag. So because of it's an indicator, it's going to be lagging. So sometimes it's not going to be as accurate. So the EMAs you're going to use, if you want to identify your daily bias, is mainly two EMAs. You're going to use your 50 EMA and your 200 EMA. These are the EMAs that will show you the direction of the trend. So let's put that on our chart now. Or let me copy this and then delete everything here. Paste it back. Right, so let's look for our EMAs, right? So let's see. You go on indicators and search for an EMA, exponential moving average, and add two of them. So you come here, set the EMA here, the length, set it to 50. This is going to be our 50 EMA. The color is going to be blue. And then the second EMA here, we're going to set the length to 200. And the color, we're going to make the color black, right? We're going to make it black. So the blue EMA is the 50 EMA and the 200 EMA is the black one. So the blue one is faster than the black one, right? So this can help you identify your trend very easily using the crossovers and the position of the market in relation to the EMAs. So what that means is if you are in a downtrend, these are the things that you're going to notice if you're in a downtrend. If you're in a downtrend, price is going to be below both the 50 EMA and the 200 EMA. And the 50 EMA is also going to be below the 200 EMA if you're in a downtrend. What begins all that movement or all that structure is when the 50 EMA crosses over the 200 EMA to the downside. That tells you that you're in a downtrend. So you can see in this entire area here, you are in a downtrend. right? Because the 50 EMA is below the 200 EMA and price is also below all the EMAs. So you're in a strong downtrend. When the trend changes to the upside, what happens? The 50 EMA crosses over the 200 EMA to the upside. So that tells you now that the market just shifted from a downtrend to an uptrend. From the first time, you saw that the 50 EMA crossed over the 200 EMA to the downside and we entered into a downtrend. And the 50 EMA now crossed over the 200 EMA to the upside. So that means now we are in a uptrend or in an uptrend. Right? And you can see price continue going up. The moment where we came into a downtrend here, right? You can see the 50 EMA crossed over to the 200 EMA. So yeah, turned over to the 200 EMA to the downside and we entered into a downtrend. But now we have this thing that happened here with news, NFP, and then price is now going sideways. So you can see whenever you see the EMAs crisscrossing like this, does know that you're in the sideways market, right? That's the reason why it's crisscrossing. Because it's meant to just cross once and then continue, or cross up and then continue. But when it is doing crisscross like this, does know that the market is in a sideways market, consolidating market. So here's what I told you about the EM is lagging. The indicator is a lagging indicator. All indicators are lagging, the ones that move like this. The reason for that is because if we're using market structure, you could see clearly that the trend had changed all the way down here. But by that time, the EMA hasn't crossed over, right? The EMA crossed over by this point here, which if you're using market structure, you would have already known that the market was going down, that it's already a downtrend before the EMA crossed over. So the EMA was lagging. The reason for that is because it reacts to what price has done. That's why it's a lagging indicator. It reacts to what price has done. But it's also good in helping you spot strong trends and when the market is about to go into sideways consolidation. Right. So whenever price is in between, or it's not price, whenever the EMAs are in between price, that tells you that you're in a sideways market. If price is above the EMAs, you're in an uptrend. If price is below the EMAs, you're in a downtrend. If price is in between the EMAs, like this, right, then you are in a sideways market. So this is how to identify your daily bias using the moving averages. So whenever it's in an uptrend, you're looking for buys. Whenever it's in a downtrend, you're looking for sells. So the third one, which is the most accurate for me, for identifying your daily bias, which it also tells you when the market is about to reverse. So the ones that I showed you, the market structure and the moving averages, they don't tell you when the market is about to reverse, and they lag somehow, especially the moving averages, in telling you if the market cycle has changed to the downtrend or an uptrend, right? But the one I'm about to show you, which I told you is the most accurate, and it's the one I teach my students. If you want to be a student, link in the description below, is what I call it's called market maker levels. Market maker levels. This is the most accurate for me that I've ever seen when it comes to identify your daily bias. And I'm going to explain it. It's a bit more complex for if you, especially if you're new to it, all right? But with time, you can understand it. So market maker levels, it tells you what it means is the market makers, smart money, big banks, whatever you want to call them, or algorithm, whatever you want to call it, they move the market in a trend that is not easily seen by the normal technical. So basically, we have two types of trend. We have the retail trader trend, which is what I just showed you, market structure, moving averages. That's the basic stuff that you see, right? And there's the market maker trend, which is the market maker levels. It's something, it's hidden in between this, hidden in the price action. So only those that have the eyes that can see it. And it tells you when the market is about to reverse and when a new trend is starting out, when the trend has exhausted and is about to reverse, when the trend is just strong. It tells you all those things. Now, this is how it works. Let me show you how it works. So there's a cycle called the market maker cycle, and this is what it looks like. You're going to have the highest point of the trend, which is called the peak formation, the peak. That's the highest point of that trend, whether it's an uptrend or a downtrend, right? So this is called our peak. We have our peak here. That's the highest point for this, if it's an uptrend. If it's a downtrend, is the lowest point, right? Where the trend reversed from. So let's say you had an uptrend prior to this, you had an uptrend like this, right? And then price reversed. This is our peak. Call it peak formation, the highest point of the trend. Now, after that, what happens? This is the market maker cycle. After this peak, you're gonna have the market going in one direction. For example, price is going up in an uptrend. Now price has reversed, is now in a downtrend. This downtrend is gonna last for three levels, and it's gonna happen like this. You have the first push here, which is gonna be level one. Price is either gonna pull back or consolidate, and it's gonna go into level two. It's gonna pull back, maybe start to consolidate a bit, and it's going to go into level three. Now, this is gonna be level one. This is gonna be level two. And this is going to be level three. So we have level one, level two, and level three. Now, once price gets to level three, once you're at level three, you should be expecting a reversal. The market is going to reverse at level three. Then you're going to get another peak formation to reverse this trend back up. And then you're going to have the same market structure or the same cycle repeating itself again, continuing up. So this is going to be our new peak formation here. And then you're going to have three more levels. You're going to have level one, you're going to have level two, and then you're going to have what? Level three here, and then you can expect the market to reverse. Sometimes they're going to level four, but most of the time, majority of the time, 80% of the time, it's three levels: level one, level two, and level three. Then it reverse. So at this point, when you're at level three, before you even have the market structure shift, before they change the market structure like this, breaking above this high or breaking above this high, before they do all of that, you already know what the direction the market is going to go to. You know that this downtrend has exhausted, and we're not going to be looking for sells anymore. We're going to be looking for buys. So understanding that, you can catch the trend at the earliest point. That's one thing I like about it. You can catch a trend at the earliest point, right? You don't need to wait till they are all the way up here before you start looking for the trend. And the way it works psychologically is that most people are going to be joining the trend here to take sales, and that's when market makers are going to trap the retail traders trading the sells, going with the trend, not understanding that the trend has reversed, not reversed, that the trend has been exhausted. That's where you hear of overbought or oversold. Price has now, sorry, the downtrend has now been exhausted, and they're about to reverse this trend to the upside. So they're going to trap a bunch of traders taking sells here, and then they're going to reverse the trend going back up. All right, so this is called market maker levels. This is what I use to identify my trend. So basically, if I'm at level one, sells, I'm going to be looking for sells, right? If I'm at level two, I'm going to be looking for sells. Once price goes into level three, I'm no longer looking for sells. I wait to see what I want to see, and then I start looking for buys. The level one here, I'm looking for buys. Level two here, I'm looking for buys. Level three here, I pause and I wait for it to reverse. Then I start looking for my trend. Or I even trade the reversal. You can trade the reversal here, and you can trade the reversal here. So this is what I use to identify my daily bias, market maker levels. That's the cycle. Now, if you look at this, you can see exactly what I just showed you. Let me clean this out. Let me turn off these EMAs. Let me paste that thing back up there. Right. So looking at this, what can you see here? Clear as day. This is your peak formation here. What do we have? We have level one. Right. After this price pulls back, consolidates all the way in here, and then we go into level two. Right. So you can see we go into level two here. Price pulls back again and begins to consolidate, and then we go into what? We go into level three. So this is going to be our level one. Level one sells. We have level two, two sells, and we have level three. Level level three sells. So at this point here, after I've seen that price has gone into level one, level two, and then I've done level three. At this point here, where's this thing? At this point here, I know that I'm not looking for sells anymore. I'm expecting buys. That's what happened here. Market makers use the news to reverse this thing back up, right? Because I've already trapped a bunch of traders taking sells here, trading continuation, expecting price to continue down, right? So we have level one. So all the way here, I'm looking for sells. 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 Once price goes into level 3 and completes level 3, I'm no longer looking for sells anymore. I'm now looking for buys to take this back up. Right now, we're still looking for buys. That's what you see in markets. Although it came back down here, we're still looking for buys. So we're going to be looking for buys here, looking for buys here, looking for buys here, taking this up. All right, expecting them to break above this level because now we have our peak formation here, which is the lowest point of this downtrend, where the trend reversed. So right now we're at level one of buys. The moment it start breaking above this high here, start going up, then we're going to be in level two. We're going to be in level two. And then from that point, we can expect price to continue up into level three that we can look for a reversal. So this is what I use, market maker levels, levels. This is what I teach my students. If you want to learn from me, you want to learn how I trade, I break this down more in depth. I show my students how to count these levels, how to identify these levels, how to know your daily bias, and how to trade my type 1, type 2, and type 3 models using this market maker levels. Link in the description if you want to learn from me. And if you guys have any questions, let me know in the comments. Also, feel free to join my trading community. The link is also going to be in the description below. And I'll see you guys on the next one. Have a nice day. Peace.